All right. Well, welcome everyone again to our series on financial dream building. And we have with us again Glenval Griffiths from Griffiths Insurance and Financial Services. Glenn, welcome.
Thank you. Thank you, Genese. Great to be here.
Right. And you know, Glenn, the funny thing, I know that a lot of people, when they think about finances and their dreams, they cannot think about insurance. They don't make that link, and it's just interesting.
You know what? It's not generally the first thought, quite frankly. And most people look at you sometimes and go, insurance? What does that have to do with that? Well, a lot, actually, a lot.
Yeah. And I think insurance plays a huge role in financial planning, right? And it's interesting to know, especially when you have children, right? The benefits that exist with insurance once it's structured properly.
It is a fundamental asset, fundamental, right? Because it's one that can be counted on. It's fairly predictable, right? And done right, you're not going to suffer loss on that.
Yeah, and that's why, I'm really actually looking forward to your presentation today because I know I'm going to learn a lot from that. So, Glenn, whatever you want to let us know more about how insurance plays a role in our financial planning, I'd love to hear more on that.
Well, all right, let's get into it. So I'm going to share my screen here and just show you guys a few slides that I've put together for presentation here. Are you seeing my screen? Oh, let me put this in presentation mode.
Yes, I am seeing your screen.
Come on, let's go presentation mode. There we go. Okay. So if you see at the top, my motto, building strength from root to fruit. It is very purposeful that you see the root, right? There's insurance and savings investments of different types. Basically, the two roots are shaking hands, but they're not just shaking hands, they're interlocked to make things stronger, right? And from that root system that nobody sees below the grass line, it's the stuff that's not seen. It's not gonna say, look at my brand new sports car. It's the stuff in the background that's making and providing the assets for everything else to grow from. That's really how insurance should be looked at, as a fundamental asset, right? So let me move on. So in this particular example, I speak to parents, I speak to grandparents, I say, gifts of legacy. We talk about intergenerational wealth. It's some buzzwords. It's the latest thing everybody talks about. But really, how do we do that? Well, I'm going to quote a guy called Garrett Gunderson out of the US. And what Garrett says he does with an insurance, he says he buys his net worth and he builds his cash flow. Buying insurance is buying your net worth, looking 3 generations ahead. Sometimes people go, wait a second, I don't even have kids yet. What are we talking about 3 generations ahead? Well, you know what? If you're going to spend your lifetime building up assets, would you at least like to steer in a direction where, for those who come after you, or if there's no kids, for important organizations and other people, that you can steer more of those assets and steer more of those tax-free assets toward them? And the answer is generally yes, right? So I use an example of, a grandparent. Look at the time of year we're getting into. We're getting close to that Christmas season. But the grandparent is looking at a grandchild and wants to make an impactful gift of legacy. They're not quite sure how to do so, right? Do they leave cash in a will? They could, but what if the child's 18 and decides to just blow the whole thing? It's possible. They pay for RESP? Well, depending on how many people are involved, especially sometimes there's 1 grandkid to 4 grandparents, those things are basically full in a lot of cases where there's no extra room to get extra benefits from the government, right? And it's very specific to education-related expenses. Or buy a rental property. Well, a grandparent may or may not want that extra work or uncertain of that, right? Let's be, at least at this point. The solution, well, I call it gap gifts. Grandparent and parent generational income facilitator system, right? Let me go into that. So grandparent, parent, godparent, aunt, uncle, etc. Someone who has an interest in this person's life, they own the policy and they pay for it. Well, you can do a 20-year pay, you can do a 10-year pay, you can do a lifetime pay. Depending on what you're trying to accomplish, I can set that up so you can see the advantages of each, right? It's possible to put, let's say if it's a grandparent doing this, maybe you put the parents of the child as contingent owner for when you pass, if you're not ready to hand that over to the child just yet, right? Or you can put the child as contingent owner. Depending on age and responsibility, of course, as I said, you could make grandchild owner of the policy. So if things go wrong, and nobody ever wants this, and I realize when we talk about insurance, strings through tighten, people get up in arms at times. They're like, you shouldn't put insurance on a child because you shouldn't benefit. No parent I know wants to collect a check like that. None. Okay, let's establish that. If that were to happen, then a death benefit is paid out. I've got a client who she collected a death benefit on her 20-year-old, and she just gave it to the other kids. It's not something she ever set up to want to collect. It was to help that child because she understood the power of insurance. It wasn't anything that benefited her because she didn't keep a penny of it for herself. But she understands that it helps the next generations, right? So if the things go wrong and the child passes early, that's paid out. But if things go as expected and that child lives a long, full life, guess what? We have an asset that could benefit not just them, but their children and their grandchildren. Let that sink in. Up to 4 generations ahead with one purchase that you can do. Let that sink in. Does that not spell intergenerational wealth? It does to me.
Yes.
Right? So, I mean, what are the advantages? Well, you got guaranteed costs, okay? And I'm going to compare to a house a fair bit. And this is not knocking a house. I'm just going to talk about predictability versus unpredictability. So let's say you buy a house for $300,000. Unless you're buying it cash, you're not paying $300,000. You're agreeing to pay that, but by the time you're done paying for it, you could have paid $350,000 to $700,000, depending. We don't know because we don't know how the financing over the years is going to go on interest rates. We don't know what you're going to pay in property tax. We don't know what you're going to pay in insurance for that house. We don't know if you're living in it, if you're going to have tenants, if it's going to be empty, what kind of repairs you have to do, how much extra you have to spend. We don't know. Here's the beauty of properly structured insurance. You got guaranteed costs, so you know from day one what this thing will cost you. You got guaranteed death benefits. You know that this is the minimum that will pay out over time, and there is a likelihood that that is going to double, triple, quadruple, depending on the child's age. Yes, you heard me right. Double, triple, quadruple possible. You get guaranteed cash values growing, predictable minimum growth that says at this point in time, this is the minimum cash value involved within the system that you can have access to in a variety of ways. Along with one of those access points, you have guaranteed automatic premium loans. So let me explain that a little bit, and I'll go back to the house. So let's say you've got a house, whether you live in it or it's a rental property, doesn't matter. You've been in it for 15, 18 years, tenants or personal, doesn't matter, but you hit hard times. 5, 6 months goes by that you can't make your payment. What happens? You're probably going to lose that asset that you worked so hard to get, right? No fault of your own necessarily, but you're going to lose that asset. Can you tap the equity in the house and ask the bank to use the equity to pay for it? Likely not. That house is just going to be foreclosed on. Well, guess what? When you look at guaranteed automatic premium loans here, the 4th bullet point down, insurance in the same instance, after, let's say, 15 years, same time period, if you are in a spot where you go, you know what, I can no longer fund this. Oh my goodness, what am I going to do? There is automatic premium loans that taps the equity that you have built up to keep this thing in force. And let me tell you, after 15 years, this can take care of itself for years, if not the rest of your life. Yes, you heard me right. Guaranteed access to cash values. So it doesn't matter what your credit is, if you're self-employed and it's hard to qualify, doesn't matter what your debt ratio looks like, doesn't matter. Guaranteed access to cash values, and all along, tax sheltered growth, right? So you can access the cash value and keep the policy still in force and growing. This is why it really is called life insurance. Typically, with insurance, somebody has to die for this thing to pay out. In this case, you can access it while alive, have it continue to grow, because contractually it has to, and use the funds for what you want. So again, you can withdraw funds directly, not the most efficient, but you can, or you can access via policy loans and collateral loans to financial institutions. And once a dividend is declared, it cannot be taken away or reduced by down markets. So here's the bottom line. If there's this much cash in it today, if the stock market drops by 80%, tomorrow there has to be more cash available, and every day after. It cannot go negative. I use an example here. In the interest of time, we're not going to stick to it, but I use an example here. Talk about $200 a month premium for a 5-year-old. You know, you get a certain amount of insurance. I have 171,000 here. But at the end of the day, I want you to look at the bottom line. At age 65, okay, worst case scenario, depending on how we set it up, guaranteed cash value 109,468. Possible cash value 640,000, and that we can talk about more offline. But with a possible death benefit of $1,039,000, and how much did they put out for this investment? 48,000. 48,000 of predictable dollars, and this thing at age 65 for a 5-year-old goes to $1,039,000, and that would be tax-free death benefit. Okay, and that cash value is possible to access tax-free. Is it possible? Yes. Do they happen all the time? Yes. Do most people know about this? No. And this is why a further conversation with me is necessary, right? Doesn't have to be 200 a month. I use that for an example. We got parents and grandparents who do less. We got parents and grandparents who do more. It is possible, okay? So I talked about accessing your cash directly through withdrawals. Your credit bearing has no interest. Your credit bearing has no limit on your access to your cash, okay? And you can use it for whatever you want. Rental property, education, retirement, health, go buy a sports car. Maybe not the best thing to do, but it's possible, right? So I'm going to finish up with this one page here. This is for the companies I deal with. Company E has credited dividends every year since 1930s, over 80 years, to all types of market. Company C distributed dividends over 170 years, all types of markets. Company F paid out dividends over 100 years, all types of markets. Company S has paid out dividends since the 1870s, over 140 years. Do you notice a trend forming? Predictable growth that comes every year. So guys, I'm going to leave it at that. Actually, I'm going to stop sharing because I don't want this to go too long, but I'm going to leave it at that and say it is possible. We think about what we can do for our children and grandchildren. And while you are the owner, you have access to this cash. So what if you fall in rough times and you can't put money into it and you may need money for an emergency? Guess what? You don't have to go to a banker. You look at what you've got for cash and you say, insurance company, I need a loan. Send me some money. They're going to ask you, do you want a check or do you want it sent to a specific banking institution? Within a week, you have it. That is the process. I do this. Look, I do this for my own family because they will have intergenerational growth. It's going to happen because that is my mission. That is my goal. And I want to help as many Canadians as possible do the same for theirs. Right. So Genese, you could tell I love talking about this. I could go on forever, but I'm going to kind of.
Yeah. I hear the passion.
Question or two. All right.
Yeah. You know, Glenn, I mean, I like the idea of accessing the cash. And I'm sure a lot of people like that. And, you know, especially when times get tough, right? And you can't get a loan, probably you don't have good credit, you know, you have the insurance. Yeah. And
self-employed and COVID. And I'll tell you guys right off the bat, I've accessed mine like 4 times already. Okay. The whole point of setting up that way is to access the cash for different things in life. Now, like a typical loan, I pay mine back because I want to build that pot for future opportunities. Right?
Nice.
So it's there.
And I also like the fact that you said it's tax sheltered. You know, I like the idea of tax sheltered. You know, we don't like paying tax. You know, we pay what we need to pay, but I like the idea of tax sheltered too. But you know, I've had conversation with so many different people, and they said, Genese, you know what? When I think of insurance, I have a bad taste in my mouth. Here, the problem is it's not really with the insurance itself. Like everything else, it comes down to how we use it, how it's structured, who is using it. And I guess for you, being the person who has been up to 2 decades now in this industry, at this time when they're feeling that, you know what, I don't want to do this, because I have a bad taste in my mouth, but they don't want to lose this benefit, right? So I'm thinking what they should do, they should come and have that conversation with you, because you have not only studied it and give it to people, but you're literally using it. You're actually eating your own cooking, right?
Denise, you're right. I'm sorry, I didn't mean to cut you off there. You're right.
That's
I'm
all
eating my
right.
own cooking and it tastes good. Do you know how exciting it is to sit and look at your kids and know that you are giving them a boost going forward, right? But you have control and access. Because make no mistake, if they come to me at 18 going, I want to cash out my money to go buy this brand new car, I'll be like, good thing you're not the owner. I still own this. That's not happening, right? When you show you're responsible enough, then I can turn over ownership. Or in the meantime, maybe you want to start a business. You have some access to cash there. Going back to people in insurance, you know what? Unfortunately, as insurance agents, we have as an industry earned a bad reputation. A lot of people have sold products they don't understand fully, that they've been taught to sell a certain way. And 8, 10, 15, 20 years later, people are seeing that these things didn't quite work out as expected. And it's heartbreaking, because a lot of these people are retired and what they thought was going to happen is not even close, right? They think I might be stopped paying now, and now they realize not only can I not stop paying, I got to put in more money, right? The benefit of my 20 years, and not just the time in, but the varied experience and setting up things properly, right? So that it is there for you when you need it, whether short-term or longer. That is what happens. So guess what? Forget the noise. Come, let's have a chat. Let's look at your situation and let's figure out what makes sense for you, so you can have great longevity and have peace of mind knowing that you are setting up your family for generations with intergenerational wealth.
Awesome. Well said, Glenn. And I couldn't have said it better myself. So you've heard it. Have that conversation. You have questions, just give Glenn a call. He says, give him a call. You have a bad taste in your mouth. I am sure Glenn can take someone sitting with him if he has a client who is interested, to get them to vent a little bit. And I know he won't take it personally, knowing Glenn. So have that conversation with him. Don't miss out. I mean, there's so much benefit in understanding this thing. As I say, it's all about being well structured, right? And there's so much benefit about it. So have that conversation. Glenn is a teacher at heart. He will teach you, let you know what he's doing. And you can know, because I'm sure you're asking, well, how will I know if it's well structured? Well, that's a conversation you'll have with Glenn. Show me and let me understand that this is well structured. Show me what it's going to look like 10 years, 20 years down the line, right? And, it's all about just being educated, you're being informed, making an informed decision, and then you can make different transformation in your life. I could talk about this for a long time, but time will not permit. So this is it for today's session. We will have more sessions. Put your questions in below. If you have comments, questions, concern, reach out. Check the description. There's contact information for Glenn in the description below as well. So don't be shy. Reach out any way you can. Glenn loves talking about insurance. He loves helping people. He loves creating an impact. So it's so glad to have you. I'm so glad you could join us, and we will be giving you more information. So just let us know. All right. Thank you.